Chapter 26 has introduced us to some financial tools that managers can use when looking at big capital investment decisions. And by capital investment, I mean using company or business resources to make significant investments, purchases of long-term assets, or investments into new business ventures. Several different tools, and we're going to look at them through some of these example problems. The first one is going to have us looking at the net present value method. And Gomez is considering a $180,000 investment that will provide the following net cash flows. So they are going to purchase an investment for 180 grand, and that investment is expected to produce cash flows over the next 5 years as detailed. Gomez requires a 10% return on its investments. So the company, the Gomez company, has said we do not want to invest in anything that is not going to provide less than a 10% return. So we are going to use the net present value capital budgeting tool to evaluate this investment and whether they should accept it. So what the net present value does is it takes the current investment amount, which is 180,000, and compares it to what the future cash flows provided by this investment, what those future cash flows are worth today. Using the time value of money, we know that the future cash flows are not worth the same as today's dollars due to the time value of money. Because these cash flows are an uneven amount, they're not the same year after year, we cannot treat this as an annuity, right? An annuity would be a series of the same amount of payments or cash flows. The amounts are different, so we can't use the annuity present value table. We have to use the present value of one table, which will basically look at each cash flow each year as a separate cash flow. So over here in the solution, we've got all 5 years cash flows detailed. What we're now going to do is I'm going to pull up the present value table, and this should be linked within your homework assignment, like the questions. You should have a link to this. This is located in the appendix of your textbook. It is Appendix B, page 11. Okay. And what you'll find in here are 4 tables. You've got the present value of one table, a present or future value of one, the present value of an annuity, and the future value of an annuity. Okay. The 2 future value tables are helping us take an amount that we have today and project into the future what it will be worth. Okay, and we're not going to work with those 2 tables. So table B2 and B4 we can essentially ignore. The 2 tables that we really are going to be working with are the present value of 1, table B1, and table B3. Okay, so remember the difference between these 2. An annuity, this table will help us take a series of equal payments in the future, payments that will be received in the future, and present value them back to what they are worth today. Whereas the present value of one table is taking one amount that will be received one time in the future and present valuing it back to what it's worth today. Okay, so going back to our problem now, each of these we're going to treat as a separate cash flow. One amount will be received one time in year 1, 60 grand. In year 2, we will receive a one-time inflow of 40 grand. In year 3, we will receive a one-time inflow of 70 grand, and so on and so forth, right? So we're going to treat each of these cash flows as a one-time cash inflow. We need to go to the present value of one table to find out what the present value of this one amount will be worth today. We are going to go to the 1 period row because this cash flow will be received in the first year, the first period. And then we are going to go over here to the 10% column. 0.9091 is our present value factor. So we are going to multiply that $60,000 that will be received one time in year one by our present value factor to calculate that $60,000 to be received in year one today is worth $54,546. $40,000 will be received in year two. We are going to present value that one amount to be received one time in the future. It's going to be received in the second period. 10% column, 0.8264. Multiply that 40,000 times the 0.8264. That 40,000 to be received in year two is worth $33,056 today. We're going to do the same thing for year 3, 4, and 5. I'm going to pull year 3, 4, and 5 in the 10% column. 0.7513 for year 3, 0.6830 for year 4, 0.6209 for year 5. Bringing those in here and multiplying those present value factor by those years' cash flows. Present valuing the next 5 years worth of cash flows as a result of this investment. Total them up. The $330,000 of cash flows to be received over the next 5 years are worth $247,300 today. That is the present value of the future cash flows. Subtract out the net investment, what we need to pay today, and the net present value is $67,300. The decision point when we're looking at the net present value, as long as the net present value of the investment option is positive, it means the future cash flows are worth more than what needs to be invested today at a 10% return. So as long as it is positive, it is a good investment option. So based off of this analysis, the net present value is positive, it should be accepted. Continuing on, let's take a look at another problem that has us working with a couple of the other capital budgeting tools. We are going to use the payback period, the accounting rate of return, and the net present value. So Garcia can invest in one of two alternative projects. Project Y requires a $360,000 initial investment. New machinery, 4-year life, no salvage value. Z requires a $360,000 initial investment, but with a 3-year life and no salvage value. The two projects yield the following annual results. Cash flows will occur evenly within each year. So these two projects, cash sales, expenses, depreciation, selling and general administrative expenses, net income. They're asking us to compute each project's annual net cash flows to start. Okay, some of our capital budgeting tools focus on cash flows. Some of the capital budgeting tools focus on net income. And when we're talking about a specific investment in a machine, the only cost that is not associated with cash flows is depreciation. Okay, so what they gave us in the problem was the income associated with each machine. But included in that income is a non-cash expense. Okay, so what we're going to need to do is in a couple of our tools, we will need to use income, but as we get to one of the tools or a couple of the tools that use cash flows, what we're going to need is to know what the cash flows are annually for each of these options. Okay, so what we're going to do first is we are going to convert this income for each project to a cash flow each year. starting with project Y. Okay. As given in the problem, this is their income. In order to convert that to cash flow, we need to remove the depreciation out of that calculation, right? Because remember, when depreciation is recorded, it's a non-cash expense. Debit depreciation expense, credit cash. But all of these other costs are paid in cash. Okay. And we're going to do the same thing for Z. Okay, the income as reported in the problem, and we're going to take depreciation out of that to calculate the cash flow for Z. Right? So now we have the income for each and we have the cash flow for each project option. First, what we're going to do is compute each project's payback period. If the company bases investment decisions solely on the payback period, which project will it choose? Now, the payback period is a very easy tool to use because what we simply need to do is divide the initial investment cost by the annual cash flow. Okay, and this formula works if the cash flows are the same every year of the project's life. Okay, and they have not told us that the cash flows will change over each of these years. So we're going to jump to the assumption or to the conclusion that the cash flows for Y will be $160,000 per year for 4 years. It has a 4-year life. And Z has a 3-year life with cash flows of $250,000 per year. So if I take the initial investment amount for Y of 360, divide by the annual cash flows of 160, I come up with a payback of 2.25 years. Project Z, initial investment of 360, divide by annual cash flows of 250, I come up with a payback of 1.44 years. Now, if the company were to use only the payback period to evaluate, obviously a shorter payback period, and the payback period is the point where the project or the investment option pays off the initial investment. Project Z is going to pay itself off quicker than Project Y. So based off of that, I would say focusing on Project Y would be the better option. Okay? It does have a shorter payback. But when you think about the fact that Project Y has a 4-year life and Project Z has a 3-year life, you know, Project Z doesn't pay itself back to almost halfway through the project's life, whereas Project Y pays itself off a little over halfway point, right? So that kind of reaffirms our conclusion that Project Z is better in terms of how quickly it pays itself off. Okay. So that is a very easy tool that managers can use. And so initially they're like, okay, Project Z looks like a good option, but let's further analyze it. So they further analyze it by using another tool called the accounting rate of return. And what the accounting rate of return does is it doesn't focus on cash flows. Instead, it focuses on the income. Okay, and it divides the income every year, which includes non-cash expenses. That's why we called it the accounting rate of return. The income divided by the initial investment. So if we take the annual income of 70 for Y and 130 for Z and divide by the average investment, well, remember the initial investment is 360 for both and neither has a salvage value. The formula wants an average investment over the life. And if we add the beginning value plus the ending value and then divide by 2, it gives us an average. Is it a perfect average? No, but it's an average and good enough for this tool. So divide the 70 by the average investment the 130 by the average investment, there's an accounting rate of return of roughly 39% for Y and 72.2% for Z. Okay, so we've analyzed this thing with payback and Z looked better. Now we've analyzed it with the accounting rate of return, taking into account all costs associated with the investment option, and it is showing us that Z is better here as well. It has a higher rate of return. So based off of the accounting rate of return, yeah, Z is the better option. The problem with the payback and the accounting rate of return is that they both ignore the time value of money. We know, having just worked through a net present value problem, that it takes into account the time value of money. So let's further analyze these two using the net present value of 8% as the discount rate. Now, the beauty of this problem as compared to our other problem is the cash flows associated with these two options, Project Y's cash flows of 160 and Project Z's cash flows of 250 per year. Those are the same cash flows year after year after year. So Project Y is going to have $160,000 in cash flows for 4 years. And Z is going to have cash flows the same for 3 years. A series of equal cash flows is an annuity. So instead of having to look at each year's cash flows individually like we did in that other problem, we can go ahead and use the present value of an annuity table. So I'm going to jump down here to table B3, and this table's factors are helping us take an annuity, a series of equal payments that will be received in the future, and present value them back to what they are today. So remember, we are using an 8% discount rate, and we're going to use the period 3 period annuity and 4 period annuity numbers. So here's the 3 period 8% column and the 4 periods of cash flows. And I'm going to bring those two present value factors back into my calculations here. Project Y was the 4-year project, and Project Z was the 3-year. Multiply the annual cash flows, 160 for Y, 250 for Z. Multiply the future cash flows by the present value of an annuity. 4 years with cash flows of 160 today are worth $529,936. 3 years of cash flows of 250 today are worth $644,275. If I subtract the initial investment amount from the present value of the future cash flows, Project Y has a positive net present value, 169, almost 170,000. Project Z has a net present value positive of 284,275. Based off of this, both have positive net present value, but Z's is stronger. Even though you're only getting cash flows for 3 years, they're higher, further offsetting the initial investment. Okay, so what we just did is looked at 3 different tools to analyze these two projects, and every single one of those tools has indicated to the manager that Z is the better option in terms of maximizing the return on investment. All right, I want to do another problem working with the net present value because this problem takes into account a salvage value that we didn't have when we were working with the net present value previously. Okay, so interstate manufacturing is considering either overhauling an old machine or replacing it with a new machine. Okay, so we have two alternatives. Management requires a 10% rate of return on its investments. So we can either keep the old machine and have it overhauled. This would require an initial investment of $150,000, which would result in $50,000 of net cash inflows over the next 5 years. And then after 5 years, we could sell the existing machine for $15,000 in salvage value. Let's calculate the net present value of this alternative. Okay, so this is our initial investment, 150 grand to overhaul it. By overhauling it, it's going to bring in $50,000 for 5 years. So it's obviously going to improve the performance of the machine, improving cash flows by 50 grand for 5 years. Then we can sell the thing for $15,000 in 5 years. So what we have here are two future cash flows, an annuity of $50,000 for 5 years and a one-time cash flow of $15,000 in 5 years. We're going to compare the present value of those future cash flows to the initial investment today. We're going to be making use of two different tables. The annuity table will help us present value the series of payments. The present value of one table will help us present value the one-time cash inflow. Right? So let's pull up the present value tables here. Present value of 1. We are going to receive the $15,000 salvage value one time in 5 years. So I'm going to go to the 5-year row. I'm going to go over to the 10% column, pick up the present value factor, 0.6209. I'm going to multiply that 15,000 to be received one time in 5 years by my present value factor to present value it back to today's amount. Then I'm going to do the same thing for the $50,000 annuity that will be received every year for 5 years. And I'm going to use the present value of an annuity table. 5 periods of cash flows, 10% column, 0.37908. I'm going to take that back to my calculations, multiply the annuity by the present value factor to come up with what it's worth today. Total my present value of future cash flows. Subtract out the initial investment of $150. The net present value of this option is $48,854. I'm going to do the same thing for the second alternative. The second alternative is to sell the new machine, or excuse me, sell the old machine and buy a new one. They can sell the old one for 29 grand today, and when they buy the new machine, they will have to pay 300 grand. And it can be sold for 20 grand in 5 years. It would result in cost savings and higher sales that would result in net cash flows of 65 grand for the next 5 years. So what we have here are 3 different cash flows associated with these options. 29 grand will be received today when we sell the old one. $20,000 can be received in 5 years when we sell it. And over the next 5 years, $65,000 in cash inflows. So the $29,000 that we would sell today, it's already in today's dollars, right? We don't need to present value that. The $20,000 in 5 years and the 65 grand for 5 years. Both of those need to be discounted or present valued back to what they're worth today. So starting with the one amount to be received one time in the future, the salvage value. 5 years, 10%, 0.6209. The annuity, 5 periods, 10%, 1.37908. I'm going to bring both of those present value factors back to my table here. Multiply them by the cash flows. Total up all of the cash flows associated with this option in today's present value amount, 287,320. So the cash flows associated with alternative 2 are 287, but if we subtract out the initial investment, alternative 2 ends up with a negative net present value. So clearly, based on this, the better alternative is option 1 because it has a positive number. So even though the old machine needs to be a little bit of refurbishment going on, it's still better in the long run. Right? Right, all the previous problems were showing us the payback period, the accounting rate of return, and the net present value method. There is one other capital budgeting tool called the internal rate of return. And so what it does is it kind of calculates the return on the investment and determines whether it meets the company's required rate of return. Okay, so for example, a company is considering investing in a new machine. They will have to invest $47,947. The machine will generate annual net cash flows of 21 grand for the next 3 years. They're asking, what is the internal rate of return of this machine? So what we're going to do is first calculate the present value factor. And to do that, we divide the initial investment by the net cash flows. That calculates a present value factor that we need to look for in our annuity table. So I'm going to jump back over here to my annuity table and keep in mind the 2.2832 factor. So I'm going to go in here, and so now I start searching through to find the factor in here that is closest to that number, and here it is right here, 2.2832, and that is falling within the 15% column. So this has calculated what the internal rate of return is. The internal rate of return is 15%. What do I do with this? Well, now that I know what the return is, I go and look at my company policy, and if the company policy says accept any investments that exceed 12%, okay, well then this is a good option, right? Because the internal rate of return calculated is 15%, exceeding the company's minimum return requirements. But if the company's policy is that all investments have to exceed 18%, well then this falls below that threshold and would not be a good investment to consider. All right, hopefully this is helpful.